Hello, welcome back, everyone, to part 2 of our discussion of Chapter 2, the expanded tax equation. And so we've determined how to determine your filing status and whether or not you have dependents, which now dependents are not a deduction straight out, but affects a lot of the credits and other things that we'll talk about later. But standard deduction is, as we see on the slide, is determined by your filing status, which is why it's one of the reasons it's so important to determine that status correctly. And so in Chapter 1, we talked about single and married filing jointly, kind of as an introduction, but there's actually a standard deduction for each of those filing statuses. Remember, if you qualify for head of household, which is kind of the most complicated of those, is kind of in between single and married filing jointly. You'll also notice that married filing jointly is double what the single is, double what married filing separately is, or you can say the single is half of the married filing joint, however you want to look at that. That didn't necessarily used to be the case, but it is now. These are adjusted every year for inflation automatically. Congress doesn't have to pass a new law or anything like that. It's set so that each year is determined by the IRS and published, late in the year for us to use. And remember, qualifying widower, you have to. It's not just having lost your spouse. There has to be the qualification of a dependent child. I notice that it's exactly the same. It really isn't a separate. It just means that someone who technically is not married can continue to use married filing jointly because their spouse recently died and they have a dependent child. So there is also an extra, additional, whatever you want to call it, standard deduction. Okay, that goes on top of the amounts that were just shown, and that is based on being older than age 65. Means if you turn 65 on the last day of the year, or earlier, you will qualify. Or if you're blind, and of course, then there has to be a definition of what blind is, and we'll do a little research about that. But that is on top of what the standard deduction we gave in the last slide. Also, there is a modification to the standard deduction if the taxpayer can be claimed as a dependent. So here goes back to the idea of what it means to be a dependent. If you are a dependent of another taxpayer. Now, first of all, you are going to file just by being a dependent. The only people that file together are married couples, okay? If you're a child or a dependent, you file your own tax return. It's not as if you file with your parents or with your parent or anything like that, or grandparents or anybody who is raising you or anything like that. You file separately a separate tax return. On that tax return, if you can be claimed as a dependent, if you qualify based on the rules we talked about in the first podcast, then you are limited in your standard deduction to the higher of $1,150 or your earned income plus $400. So if you have a part-time job and you make $2,000, your standard deduction is let's say $2,000. Let's say your standard deduction is $2,000 plus $400. So you're going to have zero taxable income because your deduction is more than your income, right? If you have no part-time job, okay, then you get a standard deduction of $1,150. All right, $1,150, $1,150, however you want to think about that. That's for the dependent. It doesn't get added to the parent's return, it is on their separate tax return that that dependent files because of their income. Now, if they have no income, they don't have to file a tax return. So if you can choose not to file, of course, if you don't have income. And there are, if you're, that's, well, a lot of children don't have, a lot of dependents don't have any income. And so therefore there's no need to file. But if they do, because there's income, this is the standard deduction. Now, the additional standard deduction, if you're over 65 or 65 and older or blind, is dependent on your filing status again. Because if you're single, you start with this single standard deduction, you add $1,750 if you are 65. If you're 65 and blind, you add $1,750 twice. So your standard deduction would be the $12,950 plus the $1,750 plus $1,750. If you're married filing jointly, okay, then you start with the married filing jointly, $25,900. You add $1,400 for each of the two. Now you're talking about, because you're filing jointly, taxpayers who are over 65 and blind. So what you could end up with is $25,900 plus $1,400 if you're over 65, plus $1,400 if you happen to be blind, plus $1,400 if your spouse is over 65, and plus $1,400 if your spouse is also blind. All right, that's the maximum, if you will, of your standard deduction. So that is how this plays out based on your filing status. All right, so if you see this, it really is, if you're married, okay, remember we're treating qualified widower technically as a married. Anybody that's treated married gets $1,400, and single is $1,750 added to your regular standard deduction. So once you subtract your standard deduction, then you have your taxable income, and you determine your tax liability. Talked about this in chapter 1. Tax liability is computed in the tax tables if your taxable income is under $100,000, and you use the tax rate schedules. If it's over, you can do the tax rate schedules on amounts lower than $100,000, because the tax rate schedules go the whole way. You cannot use the tax tables for over $100,000 because they don't exist. And then you apply tax payments and credits to reduce the tax liability. Remember, after you calculate your taxable income, after you calculate your tax liability, then you apply payments and credits. Most common payment is the withholding by your employer. So on W-2, you get your W-2. It tells you how much your income is, but it also tells you how much your employer withheld from your checks for federal income tax. But you can also make estimated payments. If you have a business and therefore you make income, but there's no employer to withhold money from your check, then you can pay estimated taxes, and actually you are required to do so if you have income from these other sources, as long as it's a certain amount, or you'll be charged interest on the fact that you didn't pay in. So the IRS is not necessarily excited to wait till April when you file to get all of your money. They want to get the money sooner than that. And they're going to charge you interest if you don't give the money to them earlier than that. When you talk about tax credits, and we'll talk a lot more about this in Chapter 9, but right now you can understand that there are non-refundable tax credits. That means that those credits can bring your tax liability to zero, but they will not give you a refund, which means if you have a tax liability of $2,000 after you calculate it off the tax table, and you have a non-refundable credit of $3,000, you're going to be able to use the $2,000 of it. The other $1,000 of it is lost. You don't get a refund. A refundable tax credit, if you had a tax liability of $2,000, okay, and then you had a refundable tax credit of $3,000, you would offset your tax liability of $2,000 plus you'd get a $1,000 refund. Obviously, you want to apply the non-refundable credits first, reduce your taxable income, your tax liability as low as possible, and then you could still get a refund for your refundable tax credits. Example of the non-refundable credit is adoption credit. Okay, we'll learn the details about that. Refundable, the earned income credit you most likely have heard of before, and the child tax credit, which technically is actually partially refundable and partially not for 2022, which is $2,000 per child up to the age of 17. So if you have excess payments, you get a refund. Okay, if you still have a remaining tax liability, then you have to pay that, or must pay that with your return, or should pay it with your return. Now, if you don't pay what you're supposed to when you're supposed to, all right, then there is interest charged, and that interest is charged whether they determine you didn't pay the right amount at the beginning, based on an audit, whether you didn't pay in when you were supposed to. Say you file your tax return, but you don't pay the amount you owe, then they're going to charge you interest. Okay, and the interest is based on the federal short-term rate plus 3 percentage points. And here's some examples of where it is. Not a really high rate, at least it hasn't been for a long time because we had very low interest rates. But that federal rate is now much higher. And so we're experiencing much higher interest rates. And so the rates on not paying or failing to pay is going to be much higher when we get this updated in the end of 2022. Okay. All right. Besides interest for monies that you don't pay when you're supposed to. And by the way, if the IRS gives you a refund and they owe you a refund and they don't pay you for a certain amount of time, they actually have to pay you interest as well on a similar basis as we talked about. So it is a little bit fair, I wouldn't say entirely fair. Penalties. If you fail to file your tax return, okay, so the tax return, the 1040, personal tax return is due April 15th. You can get an extension, but if you don't file an extension and you don't file that tax return, or you file an extension and you still miss the extended deadline, then your failure to file a tax return is penalty is 5% per month or fraction of a month. So as soon as you go 1 day into the new month, it's 5%. But it's not going to exceed 25%. So after 5 months, you might say, you have little incentive to file the return because your penalty is not going to get any higher. Okay? And it's based on the tax that's due, right? Okay? So that means that this penalty isn't going to be much of an incentive if you, as a taxpayer, are going to receive a refund, meaning because this is based on how much you owe and you don't owe anything that IRS owes you, okay? So any income tax return not filed within 60 days is subject to a minimum of the lesser of $450 or the amount of tax required on return. So again, no matter what, if you miss it by 60 days, you're going to have to, your minimum amount is going to be $450 or the amount of tax, which it means you just doubled the amount of tax you owe. On top of that, if you fail to pay the tax with it, okay, so this is in addition to interest, you are going to pay a tax penalty if you file but don't pay, you're going to have your failure to pay tax penalty of 0.5%. Notice how much lower that is than the failure to file. So definitely, even if you cannot pay anything, you should always file your tax return because of the much higher penalty for failing to file than failure to pay. Okay? And again, Now it's going to go up to 20, maximum is still 25%, but that's going to take a lot longer to get there. And again, it's just per month or fraction of a month. So as soon as one day into the next month, and remember, it starts on the 15th of April, assuming you don't file an extension. So April 16th, your failure to pay tax penalty is 0.5%, and that's the same penalty all the way up until May 14th. And then on May 15th, depending on how the work the day, 16th, okay, you're going to be into the new month and a new 0.5% or 5% penalty. Now, there is a situation where if you don't file and you don't pay, which is usually the case, if you don't file, you also don't pay, okay, your maximum amount is 5% per month, okay, a fraction of the month. So basically, the 0.5 is rolled into the 5%. Okay, so if both penalties apply, you're only going to be charged the one penalty, the bigger one, of course. Then if, and this is after the due date, right? This is after April 15th. But if, as we talked about, you didn't pay in earlier, you're going to be charged interest or failure to pay estimated income tax penalty. That applies if the taxpayer fails to pay the current minimum of 90% of the current year's tax or 100% of the prior year's tax. Okay? And if it's less than $1,000, we're not going to charge you anything. Okay? They end up owing. So you need to do that as you earn the income, or at the latest by January 17th or January 15th or whatever the closest business day is after the year that you earned it. So this is if you don't pay, if you didn't have enough withholding tax, okay, even if you pay it on April 15th. So for instance, let's say that your tax liability is $5,000, okay? During the year, your employer withholds $3,000, okay? When you file your tax return on time and pay the other $2,000, okay, you're still going to be assessed this failure to pay estimated income tax penalty because you did not have enough withheld. You're going to still be charged. The penalty is more than $1,000, and they're going to figure out what you should have paid, and they're going to charge you interest from the times that you should have paid it over the course of the year. Okay? And that is really the same percentage as the interest rates we saw earlier. Okay, so it's basically interest. Now, if you really miss the amount of tax that you should have paid. Now, this is accuracy-related penalty is you filed a tax return. Okay, they checked it, audited it, or something, and it was wrong, or it didn't match up with something, or whatever, and you're off by a substantial amount, and of course you can argue about what substantial means, then you could be charged a accuracy-related penalty of 20%. And 20% of the amount the tax due could be substantial. And then, even worse, if they feel like you intended to defraud the government and file a tax return that was incorrect, then they can apply a penalty of 75%, the fraud penalty. All right, especially if you claim a refund, use the wrong tax return to claim a refund, okay, then that penalty can be 20% as well, okay? But that would not be in addition to your fraud or accuracy-related penalty, which you probably were also charged. So that's not going to come into play too often because you probably have one of the others already in place or been charged.